Today, we are looking at Northern Star Resources, an ASX-listed gold producer that sits in a very different risk class to most mining companies discussed on this channel. Northern Star is not a story about discovery hype or speculative drill results. It is a company built on acquisition discipline, operational control, and long-life assets in some of the safest mining jurisdictions in the world. This is gold mining as infrastructure rather than exploration theatre. At its core, Northern Star represents a question investors often overlook during commodity cycles. What does a well-run mining company actually look like when the excitement fades and the spreadsheets matter again? With exposure to Tier 1 assets such as the Kalgoorlie Super Pit, a portfolio of mature underground and open pit operations, and a management team known for restraint rather than bravado, Northern Star has become a benchmark for how gold production can be scaled without destroying shareholder value. In this episode, we are not asking whether gold will go up tomorrow. Instead, we are asking whether Northern Star is structurally positioned to survive, adapt, and compound value across cycles, inflation shocks, and geopolitical stress. As always on Tech I Spy, this is not a recommendation. It is a strategic breakdown. We will start with the company's strengths, move through its weaknesses, examine where genuine opportunity still exists, and finish with the threats that even the best-run miners cannot escape. Let's begin. Strengths. Northern Star's primary strength is not scale alone, but the quality and maturity of the assets it controls. This is a company built around deposits that are already proven, already productive, and already embedded within established infrastructure. That matters, because in mining, the highest risk is not running out of gold, but failing to turn geology into cash flow. Northern Star has crossed that threshold. At the center of the portfolio sits the Kalgoorlie Super Pit, one of the most recognizable gold mines on the planet. Ownership of such an asset does more than provide ounces. It provides optionality. Large, long-life deposits allow management to smooth production, adjust cut-off grades, and sequence mining in response to gold price cycles. Smaller miners do not have that luxury. They mine what they must. Northern Star can mine what makes sense. Operational discipline is the second pillar. Northern Star has developed a reputation for meeting guidance, controlling costs within the limits of a highly inflationary industry, and resisting the urge to overpromise. This may sound unremarkable, but in the gold sector it is rare. Many producers expand aggressively during bull markets, dilute shareholders, and then spend the next downturn repairing balance sheets. Northern Star's growth has been slower, but it has also been survivable. Jurisdictional quality reinforces this strength. Operating primarily in Western Australia and Alaska places Northern Star in regions with stable legal systems, established mining regulation, and deep labor and service markets. This reduces sovereign risk, lowers the probability of sudden fiscal shocks, and makes long-term planning realistic rather than theoretical. Cash generation underpins everything. Northern Star is structured to generate free cash flow across a wide range of gold prices, not just at cyclical highs. That cash flow funds sustaining capital, exploration at existing operations, and balance sheet resilience without constant recourse to equity markets. In a sector where dilution is often the silent killer of returns, this matters more than headline production growth. Finally, there is management culture. Northern Star is widely regarded as one of the better capital allocators in the Australian gold space. Acquisitions have historically been made when assets were undervalued or operationally mismanaged, with value unlocked through execution rather than financial engineering. This approach does not produce dramatic headlines, but it does produce durability. Taken together, these strengths place Northern Star in a category many investors underestimate. It is not an exploration story, and it is not a momentum trade. It is a company designed to endure gold cycles rather than chase them. Northern Star's greatest weakness is that quality does not eliminate complexity. The very scale and maturity that make its assets valuable also make them demanding to operate. Large open pits and deep underground systems are never simple machines. They require constant capital, constant monitoring, and constant technical competence. When something goes wrong, the consequences are rarely small. Capital intensity is the most persistent constraint. Sustaining production at Tier 1 assets requires ongoing investment in development, equipment replacement, tailings management, and processing infrastructure. This means that even in strong gold markets, a meaningful portion of operating cash flow must be reinvested simply to stand still. For investors expecting explosive margin expansion, this can be frustrating. Operational concentration is another subtle risk. While Northern Star has multiple assets, a significant portion of group performance is still influenced by a handful of major operations. Any extended disruption, geotechnical issue, or processing bottleneck at one of these sites can materially affect group output and costs. Diversification exists, but it is not infinite. The company is also exposed to the structural cost pressures facing Australian mining. Labor shortages, rising energy costs, contractor availability, and compliance overheads have become long-term features rather than cyclical annoyances. Even well-run operators struggle to fully offset these pressures, and Northern Star is not immune. Cost control in this environment is about damage limitation rather than outright victory. From a market perspective, Northern Star's conservatism can itself be a weakness. During speculative gold bull phases, capital often flows toward high-risk explorers and developers, offering dramatic upside narratives. Northern Star's measured growth and disciplined messaging can cause it to underperform more speculative peers during these periods, even if it outperforms over a full cycle. Finally, there is gold itself. No matter how well the company is run, Northern Star remains fundamentally exposed to the gold price. Prolonged weakness compresses margins, delays discretionary investment, and can shift investor sentiment away from even the best producers. Operational excellence reduces this risk, but it does not remove it. These weaknesses do not undermine Northern Star's business model, but they define its limits. This is a company optimized for endurance, not excitement, and that trade-off is deliberate. Northern Star's opportunity set is shaped less by discovery and more by optimization, longevity, and macro alignment. This is where mature operators quietly create value while the market is distracted elsewhere. The most immediate opportunity lies in extending the life of existing assets. Large, well-understood systems, such as the Kalgoorlie Super Pit and Jundee, still offer meaningful upside through infill drilling, improved geological modeling, and better mine sequencing. These are not headline-grabbing discoveries, but they can add years or even decades of production at relatively low incremental cost. In mining economics, extending mine life often delivers better returns than building something new. Operational leverage to the gold price remains a powerful, if understated, opportunity. Northern Star already has the infrastructure in place. When gold prices rise, A large portion of that upside flows directly to margins rather than being absorbed by development risk. Unlike developers, Northern Star does not need higher gold prices to justify construction. It needs them to accelerate value extraction. Technology and process improvement provide another layer of opportunity. Automation, data-driven maintenance, and incremental improvements in processing efficiency can reduce unit costs and improve recovery rates across the portfolio. These gains tend to be gradual, but across high-volume operations, they compound meaningfully over time. From a capital markets perspective, Northern Star is positioned to act when others cannot. Down cycles in the gold sector regularly produce distressed assets held by over-leveraged or poorly managed operators. With a strong balance sheet and operating credibility, Northern Star has the option to acquire quality assets at points in the cycle when value is mispriced. This strategy has worked before, and it remains available. Finally, there is the macro backdrop. Persistent inflation, central bank accumulation of gold, geopolitical fragmentation, and rising distrust in fiat systems all support gold's role as strategic insurance. If gold transitions from a trading asset back into a reserve asset in investor psychology, companies like Northern Star stand to benefit disproportionately because they offer scale, liquidity, and survivability rather than speculation. These opportunities do not rely on optimism or breakthroughs. They rely on time, discipline, and a gold market that slowly remembers why the metal matters in the first place. The most persistent threat facing Northern Star is cost inflation that outpaces control. Australian mining is operating in a structurally tighter environment than in past cycles. Labor shortages, higher energy prices, contractor scarcity, and rising compliance costs are no longer temporary headwinds. Even disciplined operators face margin compression when these pressures compound. Northern Star can manage costs better than many peers, but it cannot opt out of the system it operates within. Geotechnical risk remains an ever-present reality. Large open pits and deep underground mines are engineering achievements, but they are also complex living systems. Ground movement, unexpected faulting, or changes in ore geometry can disrupt production schedules and force expensive redesigns. These risks increase with depth and scale, precisely where Northern Star's most valuable assets sit. Regulatory and environmental pressure is another slow-burning threat. While Australia and Alaska are stable jurisdictions, mining is increasingly scrutinized. Approval timelines lengthen, reporting requirements expand, and social license expectations rise. None of this tends to shut mines overnight, but it steadily increases operating friction and capital requirements, particularly for long-life assets that must plan decades ahead. Gold market volatility itself is a structural threat. Gold equities are often treated as short-term proxies for bullion rather than long-term businesses. Sharp shifts in investor sentiment can compress valuations even when operations remain sound. This can restrict access to capital at precisely the wrong moment in the cycle, particularly if broader equity markets are under stress. There is also a strategic threat tied to success. Large, high-quality producers attract institutional ownership, which can increase correlation with broader market movements. In periods of forced selling or risk-off behavior, even fundamentally strong companies can be sold indiscriminately. This does not damage the business directly, but it can distort valuation and investor patience. These threats do not imply fragility. They define the boundary conditions within which Northern Star must operate. The company's strength lies in recognizing that gold mining is never risk-free, only risk-managed. and that survival over decades is a more demanding test than performance over a single cycle. Conclusion. Northern Star Resources sits in a category that is easy to overlook precisely because it lacks drama. This is not a company selling a future discovery, a technological breakthrough, or a once-in-a-generation narrative. It is selling something far less fashionable and far more difficult to execute: durability. Across its portfolio, Northern Star demonstrates what gold mining looks like when the priority is not excitement but survivability. Tier 1 assets, conservative capital allocation, and jurisdictional stability combine to form a business that is built to operate through inflation, political noise, and commodity cycles, rather than being dependent on perfect conditions. The trade-off is clear. Investors looking for rapid upside during speculative phases may find Northern Star uninspiring. Its strength is compounding, not acceleration. But when cycles turn, financing dries up, and weaker operators are forced into dilution or retreat, this is the kind of company that remains standing and often emerges stronger. For gold to matter as more than a trade, it must be backed by companies that can actually deliver ounces year after year without destroying value. Northern Star represents that end of the spectrum. It behaves less like a bet on gold and more like infrastructure built around gold. In that sense, Northern Star is not asking investors to believe in a story. It is asking whether discipline, scale, and patience still have a place in a market that often prefers noise.